Alright, good morning. Today is Monday, April 21st, 2025, and today's short little video, I'm just going to be logging and sort of exercising my first presentation fair value gap identification and usability. So it's just a little exercise that I kind of came to myself. I don't want to take credit for it. I'm sure it's nothing advanced, but this is sort of what I do and what I plan to do for the next few weeks, just to get familiar with the first presentation fair value gap. I've looked at the first presentation fair value gap for a few months now. It definitely is helpful, and it is the most utilized gap based off of time, in my opinion. So there's a few points of the day where there's lots of volume, and 9:30 New York Open is one of the highest on average points of volume. So it's not that difficult. So if there's lots of volume there, that means there's lots of orders based around it, whether it's the high or lows, and so you can expect some. It's not always going to be perfect, a clean shot lower or clean shot higher, whether it's a bearish or bullish gap. It is typically going to consolidate or sweep either side of the market based off of that gap. And so what I've noticed is the closing of the candles is a huge giveaway on what's next, which side of the marketplace. And so a couple things that are not included in this lecture is the first presented fair value gaps for, let's say 10:30, let's say 11:30, 12:30, 1:30, 2:30, and 3:30. So typically those are the ones that I'm using. In this example, I'm just using 9:30. So that's just to sort of build an understanding of the gap. But when I'm watching real-time markets, I am utilizing all of the first presented fair value gaps and any other gaps. So anything else? Yes. I will also be in my own logging exercise. I will include 30-minute highs and lows. So if you go on a 30-minute chart and mark out the highs and lows on the first 3 candles prior to the candle that's trading or the time we're looking at. 3 is just a rough estimate. I like to look at the first or second only, just to kind of keep things clean. It helps also your liquidity. I guess the best word to use is pinball volatility type of liquidity exercise. So it keeps your focus to a certain pool of liquidity. So basically, my main focus on this is, and if you're also wanting to follow along, the main focus of this video is following a process-orientated thinking. Not trying to fall into the trap of reacting. Not trying to, trade your emotions based off of the gap. There's lots of times that a gap seems like it could inverse, and that's actually a part of this, is that typically when a gap forms, and what I've noticed, and I could be wrong, but I've written this down in my logs and my notes, that when the gap forms, and I'll get started with this example actually. When the gap forms right here at 935, it's a SIBI. And I'm just going to use SIBI or BISI. I'm not going to pronounce the whole thing, it's too much. So it's a SIBI. So it's, I really want to say sell side imbalance, buy side inefficiency, but I'm going to try to refrain from using that. So basically, you really have two sort of paths that the market can take from here, and that's to either utilize it as what it is, which is a bearish fair value gap, or it could inverse and trade higher. So now, obviously, this goes without saying, but we are looking at a 1 minute time frame. But in your backtesting, you're going to want to look at higher time frame charts like a weekly draw on liquidity. You're going to want to look at the economic calendar for scheduling and where manipulation is likely to fall. And obviously, if you want to incorporate other things like seasonal tendencies, retail sentiment, go ahead. And so that sort of gives you an idea as to what I'm about to discuss here. So we have that 9:35 a.m. SIBI, the first presented fair value gap. Once again, like I said, it has two options here. It has the option of utilizing it as a bearish fair value gap, bearish gap, or a inversion gap. And the idea here of this exercise is to see whether what it's using it as, and if it's not using it as a bearish gap, when does the narrative change, and what key details does it give you just using a 1 minute chart, just using the gap high low, not even the consequent encroachment. It's very simple of an exercise. So the rules are, if a candle closes above the high of the gap, then that changes the narrative, and you would use that as a bullish gap or a discount array. If the candle closes below, then it's bearish. And this is pretty simple. You've probably heard this 1,000 times yourself watching lectures, but it's good to classify rules because I like to keep it in my logs just because it keeps everything fresh for me. So if we look at this example right here, we have this gap at 9:35. The market trades lower. We're not focused on this gap, even though it provides a clean sell over here. We're not looking at that, so I'm not even going to discuss that. So we do have the market trade lower from there, which makes it seem like the market is breaking away from it, treating this as a breakaway fair value gap. But at 10:04, the market has its first interaction with the bearish gap, SIBI, right? So it has its first interaction, and I'm going to actually personify this logging exercise at some points, just to make it a little more memorable for myself, a little more memorable for you, and maybe you'll enjoy logging like this. I prefer to make the logs, make them like stories, but that's for me. Okay, so at 10:04 we have the first interaction with the low of the first presented fair value gap at 9:35, and at 10:05 we have another interaction, but it fails to close. So right here we've touched the low, we've went up, we've touched the high, and then at 10:06 we have the high of the gap touched once more. Now, another thing you can incorporate is macros, right? This is a macro time from 9:50 to 10:10, but I'm not going to get too into that, as I don't really utilize macros, or I haven't studied macros to the point where I feel like I can discuss about them. So that's something I'm working on, that's something I'm studying, and I'm taking one step at a time. So 10:10, sorry, I said I'm not going to speak about macros, right? So from 10:04, 10:05, 10:06, 07, 08, all throughout here, you can see that, we never really come back up into that gap again, and we didn't close above it here. So what I put on my journal to the left is I put 10:04, bearish fair value gap, then a slash, SIBI. And what I'm trying to get at is that the market is treating that gap at that time as a bearish fair value gap, SIBI, based on the close of that candle. And until we close above it, I don't write anything else the line below. So you go forward all throughout here, it's reasonable to go short from these three candles, whichever one, right? Then fast forward a little bit to 10:40. So 10:40 is the last candle before the narrative changes, right? Because that's the last candle that goes up to price, or the first presented gap, before at 10:41 we close above it, right? So then I have 10:40 a.m. bearish fair value gap slash SIBI. So far nothing has changed until we get to 10:41 over here and change the narrative. The market has now closed above that gap. You can see that right there, that the close is higher than the 9:35 a.m. gap high. And so reasonable expectation is for the market to trade higher. Now this is where you'd include all your other analysis to see, does my plan allow for that? Does my plan incorporate or include the flexibility for the market to trade higher? In this case's scenario, which this is where you would go back to previous video and see that we had a turtle soup sell above the 1 minute 6 p.m. candle. So go back to yesterday's video and see that the market went up to a high, and that is a classified turtle soup sell, so it's reasonable for it to not return back up into that high, which is right here, right? So yes, it does technically have all this room to come up into here, but it closes here, and you would start to see, okay, does the market trade any higher? Does it trade to these highs right over here? Okay, that is at 10:41. Then we have 10:42, which comes back into it, closes, but not below. So I don't mark that, I don't log that, I leave it, move on to the next. Then we have 10:43, trades a little lower, even goes all the way down, right? But does not close below that. It actually closes inside the lower quadrant. This opens, this 10:44 candle opens, trades below the previous candle's low, and closes. So that's why I have that line here, because now you'll start to notice that any point where there's a flip in price that changes the narrative or closes below the high or low, I have a little line over here. And obviously this one, there's no change in narrative, but it starts the beginning because that's the first interaction with the gap. So we have 10:44 a.m. The market reclaims that fair value gap as a civvy. So the market should now treat it as resistance. And so it trades a little bit lower, and trades into these equal lows, basically, into this consequent encroachment of this wick, and comes back up. This is the last candle of that narrative that is told as a reclaimed bearish fair value gap. That's basically what I'm looking at. So, meaning that at 10:49, that was the last candle that interacted with that gap before we closed above it. And then 10:50, so macro timing begins. 10:50 closes above that gap. So I marked that on my paper as 10:50 a.m. bullish inversion fair value gap, but it's still a SIBI. So that's how I'm looking at this. And also, if you go back to how to streamline your trading view object tree, I discuss all these little sort of annotations and how I view them, how I internalize them, and how I organize them. So, and I also talk about the object tree. But if you just want to go see what these annotations mean, it's pretty simple. So then we have 10:54 right here, which was the last candle before we switched narratives, correct? So we have 10:54 and we have 10:55, the next candle that closes below here. Basically melting through butter like a hot knife is the best way I can put it, that the market trades lower and closes and then fails to even touch that ever again. And then now you fast forward, which I've already done. I'm not going to do this right now. I've already done this all, so I'm just going through it with you. The market never ever comes back up into there. So that was basically 1, 2, 3, 4, 5. So 4 to 5 points where the narrative changes, but it gives you a very nice, if you want to put it this way, go ahead. If you were to code an indicator or an algorithm of your own, and you had to give it some sort of criteria or requirement, it would be closing above or below the high and low. And so you can see that right here it closes, which would tell that signal to the algorithm that it wants to, or it's likely to start expanding for sell side. We have equal lows here, and then we have this low here. So as you can see, it does trade there off the premise of this gap, 10:56 a.m. and there's multiple other gaps here. 11:05, that's the first presented fair value gap for the 11 a.m. hour, right? And so fast forward, next day on Tuesday. Now this is old annotations. I don't specifically remember if I talked about this, but I'm just going to remove that for time's sake, just to create less confusion. I did talk about this though. Buy side, sell side, buy side, sell side, expansion, and then expanding up into those highs. So that was on a 15-minute chart. So we're using 15-minute chart and now digging into and looking at this with a magnifying glass on a 1-minute chart. Alright, so Tuesday, you can see the first presented fair value gap right here. 1 minute, first presented fair value gap as a buy side imbalance, sell side inefficiency, or a BISI. I said I wouldn't say it, but here we are. And it's also incorporating the volume imbalance, high and low, on both ends. So I have that annotated as April 15th, 2025's first PFVG. Alright, the first interaction, which I actually do not have marked here, is 946. So there it is, 946. We have the first interaction with that gap, and it treats it as such, a bullish fair value gap, sending it into new highs, but not for long. And the next interaction is made at 10:17 a.m., which actually, sorry, 10:18 a.m. So, sorry, I had to change into shorts. It's getting kind of hot. So, 10:18 is the first interaction with that fair value gap, but we close perfectly at the low of that gap, accounting for the volume imbalance in price. So if you really were astute about this, and this is just for logging purposes, there's a little gap in here in price where the market trades down and up, opens, and then trades up into the volume imbalance, which gives you from 19,010 to 18,924. So almost 100 handles, but about 80 to 90 handles. And that is a good amount, but I don't think that's very, very tough to spot, in my opinion. So even I don't think I would be able to recognize that or put any trade off of that, considering that we didn't close below the the first presented fair value gap. But if you were to use that high, or the candle high, then yes, you could. But once again, we're following rules here, and we are focusing on following a process-orientated thinking. So it comes down to building your model, and 99% of the times, even 100% of the times, I will always draw the gap like this. So, and you can see it'll serve me well. So 10:19, we have that change in narrative where price should treat that as a inversion bearish gap. Even though it's a busy, even though it's supposed to be bullish, because we have now closed below it at 10:19, price is going to come up into there, and this is the expectation that it's going to come up into there and sell off. Now, how low is really up to you. If you have targets that are on the daily that you believe now is the time where it's going to go there, I'm not even going to get into that, but the bare minimum is that low right there. We have a long wick here. You can see it trades into that, and from here, it's still a bearish fair value gap. Let me put all of this away. Your focus is here, so it's still a bearish fair value gap, because even though it comes up into here, closes inside of it, closes inside of it, closes inside of it, once again, closes below it, below it, below it, below it. Nothing changes till 10:42, which is the last candle that interacted with price before the narrative changes for that gap. And so you can see 10:43, we open, we come down, fail to touch consequent encroachment, and then close way further than where we opened, relative on a 1 minute chart. Alright, so now I'm taking this candle by candle. 10:43 is what we're looking at. Then we have 10:44, 10:45 right here, 10:46. Look at that. We go all the way down, sweep the sell side here, right? So this is what I'm looking at. So sweeping this sell side, and still closing inside of that gap. So nothing has changed yet. So 1046, 47, 48, and there we go. Now we have some sort of change in the narrative that price has closed below. So 1050, things have changed once again. Alright, 1050, we are now treating that gap as inversion fair value gap bearish. So it formed as a buy side, is a BISI, but now we're treating it as a resistance level or zone or price PD array. Right? Then fast forward 1054, we have this sort of formation going on here, and then price closes above the gap one more time. So that's 1055 that we have price treating that as a reclaimed fair value gap, or a reclaimed bullish fair value gap. And so the expectation would be that price should go up there, up here, using this as a discount array. Now the first thing, if I were looking at this real time, the first thing my eye would draw to is this immediate rebalance inside this inversion fair value gap, accounting that volume imbalance right there. But because, so now we have two conflicting PD arrays. This close is telling you that, okay, price is going to go higher. Alright, but how high? Well, this looks like a clean sweep, so not any higher than here for sure is what I would say. And this is my inner musings if I were to be watching this live. Not any higher than here. And so looking lower, we have this gap. Okay, I wouldn't prefer for it to go down in there because we came up and repriced to the high. So we have this sell side imbalance, buy side inefficiency. So sure, it can sweep those highs, but immediately I would want to see it trade below this gap at some point in time. So now we wait for time and price. Alright, so 1056, and I'm going to go a little faster here. 1056, you can see still treating it as discount, trading it as discount. What does it do? It sweeps that high, but it comes back into the range, fails to close below it until right here. There we go. I'll leave that candle in there. What time is that? 11:36. Right? So 11:36. Now we're telling ourselves that this candle has closed below, and I'm going to put this in full sentence. This candle has closed below the 1 minute first presentation fair value gap, buy side imbalance, sell side, formed as a buy side imbalance, sell side inefficiency, accounting for the volume imbalance that was formed at 9:38 on April 15th, 2025. We have swept liquidity over here. We have traded inside this premium array, and my plan suggested that we should not trade to this buy side liquidity here. So then I would go and treat this as a short for targets below here. So next candle still does not close below that. Okay, that's concerning, but you can see it's not closing above that, is what I meant last time. Sorry, that's what I meant. It's not closing above that. If it closes above that, it changes the narrative and we reassess our plan. But you can see no change. Keep going, and there we go. So at, what is this, 11:52, we have a reclaimed bullish fair value gap as a BISI. Okay, so that plan has failed to pan through, is what I would tell myself. Alright, I would cut the trade if I were in it, and I would reassess and re-enter at a later time using this as a target. So now, same thing that we were looking for here as a short, but reversed until we have a change in narrative where price closes below that gap. Okay? So basically I just be patient, allow for any sweep of liquidity, but still I don't think, with the obviously benefit of hindsight, I'm not looking at this to be swept this high. And I watched this live, so I can say with certainty that I wanted this to be not traded to. So I was on my phone looking at that, and I was looking at that sell side on Tuesday. Alright. Okay. Starting to reach back down. Waiting for that close. Alright. Now ignore that yellow highlight. That is, I will get to that in a second. Just going to speed it up here now. Alright, so now until we close below that gap, so now once we close below that gap, I'll speak about the yellow and red box. Alright, coming back up, and there we go, right there. Perfect, right? 1252 is the moment the narrative changes, and price has now essentially told us that this gap is going to be treated as a what is this? Inversion bearish fair value gap. Alright, why? Because it was formed as a buy side imbalance, sell side inefficiency. So now it's going to treat it as inversion bearish fair value gap, or bearish inversion gap. Okay? Now, these lines, or these rectangles, is basically a micro market structure, market maker sell model. Just like a rough estimate, nothing super specific, but if you just look at the accumulation here, manipulation, and then you would look at this, and we have that whole entire plan. So this is where your planning starts to come to life and come to existence, and how it's formed. Meaning that these plans were formed before, and I mentioned that we were waiting for time, which was every single time that the market closes below that gap, and price, which was we were looking at this specific price, right? And so how did the market treat that, and at what time did we close below it? So we have accumulation, manipulation, distribution, or anticipated distribution right here, and we also have this gap over here, this large gap, which originally, and this is the best way I can put it, screwed us in our plan, right? So we know that if it screwed us, there's millions and millions of positions in the marketplace, and some of them, I can't say exactly, but using core content 1-to-1, we know that there's large pools of liquidities, there is large participants, and despite we don't know the number of participants, but we know that there's always short sellers, is what, if you want to call them that, and there's always buyers. So there's always sellers and buyers, meaning that there's always people in the marketplace who are short, and there's always people in the marketplace that are long. So anyone who is short here, which in this hypothetical scenario we got screwed above this high, essentially. So I trust using this not as a BISI, not as a bullish fair value gap, but I want to see it trade below this low, come back, meet inside the lower quadrant, and then sell off to right over here. And so you can see I have my little magnet here that was from the 7:33 a.m. fair value gap that I hid. But if you take the high and low, that's also a good draw on liquidity. Even though price has traded through it and to it multiple times, it's still a great draw. It's still a great reference if you want to hold for a lower target over here. So, drawing this out, marking that as inversion, and I'm going to keep that darker shade, but I'm going to throw this to the back like that, and I'm going to draw that like that. So basically, oops, like this. So we have the lower quadrant, which is the 0.25, and we have the equilibrium. But we want to see our anticipated setup form at the lower quadrant. Now that we are below price, we want the market to draw here, and we want the market to eventually reach terminus at this 10:20 a.m. low, and we do not want to see it come back up here because we've seen A, we've seen M, and now we expect to see D, meaning accumulation, manipulation, distribution. So I'm going to just zoom in a tad bit, and I'm going to start moving forward. So price has now met that 7:33 a.m. gap, that first presented fair value gap at 7:30. So you can see that if that's the zone, assume that magnet is the high and low. I'll just turn it on if I can find it. $15, 7:30. Or was it 8:30? No. Okay. It might have been unlabeled, so that's not it. No. Okay, that's fine. I can't find it right now. It may have actually been incorrect. No, I don't think so. I'm pretty sure there was a gap here. I may be wrong, but the idea is, if there was a gap here, assuming I'm correct, I do remember there being a gap there. The one that I turned off. I'm gonna go there. Now it's pissing me off. 7:30. Go to 7:30. We have that first presented. Yeah, that first gap right here, and extend that out like I do right here. First presentation, and right when we touch it, right there. So we touch it. You want a partial there, go ahead. But we're holding for down here. And so market trades above it. But remember, our setup is anticipated or expected to trade at this lower quadrant. And so we go forward. We're watching these candles in hindsight, but the expectation is to be watching this real time. We touch it. Alright. And now we want to see it close below the first presentation fair value gap at 7:33 a.m. Alright, so that's the expectation. We touched it. We should no longer see it touch it again. This is a very clean setup, high probability, and so my expectations would demand a lot. I like how we went up into this volume imbalance. All I'm looking for here is for it to not violate this high, and then for it to close below this white line, the low. And the level is 18,971.25. Boom, right there. And now we're looking at our targets right here, right there. And as you can see, sells down off into there, using everything that I've outlined here with the benefit of hindsight. But these are things that I like to study, and I'm gonna take a few minutes to discuss this setup right here. these are things you will not have, I will not have, at least I do not have all of this incorporated into my analysis real time, but I'm able to pick up on these larger gaps like this one right here at 1152, and I'm able to keep them in my head, a very short-term idea, and I'm able to just draw a rectangle on them. Whether I label it or not is unimportant, and I'm able to have the expectation for them already set because of backtesting. So when ICT, in my opinion, when ICT talks about fluffing up your backtesting and making it lovely and making it in a manner where you would love to go back and read it, this is that for me. I love to go into detail. And so going into detail for me is like, it's a turn on in price. And so when I'm able to look back at these setups, whether I have seen it real time or not, and follow a rule, follow a plan, follow the model, it's very, very rewarding for me to be able to do it in first hindsight, but even more rewarding to be able to do it in real time. So maybe, I don't have every single level. I didn't look at this yellow and red box, but these are new things that I pick up on when I go back and look at it in hindsight, right? So it's very cool to be able to do that. It's new learning experience, and you can couple 100 other things inside of this, but this is just naturally what I picked up on. I saw this gap and I knew it, right? Real time, I knew it. I was like, oh my god, that looks like a fake out. That looks like some traders would want to go long on that, and I have my expectations at the sell side since basically when it formed, right? It was at 10:30, 11, between that 30-minute time frame, where I had that sell side drawn out, because that's the, if you go to 10:30 and then look back 30 minutes after 10:30, so if you go to 10:30, look back 30 minutes and take the high and low from 10 to 10:30, that's the low that you fall with. And yeah, very clean, very nice. No matter, despite us, trading around here all the time, you took one small loss. If you have proper stop management, if you are able to stay in the game for long enough, and maintain a cool, calm, and collected mindset, this is nothing. This trade is easy. If you allow yourself to get tilted off of this and fearful, which would be without back testing, this is not possible, for me at least. So this is just what I've experienced and what sticks best for me and with me. Alright, and so moving on to the next exercise. I'm not sure if my mic went on mute there, but I was just turning on my walking pad, if you heard that. Trying to get my 12,000 steps in, so alright, anyways, Wednesday, and I'm just going to speed through these now, because this video is about an hour long now, so 45 minutes. So we spoke about the last setup, and using the first presented fair value gap to qualify and disqualify trades. So basically just putting the puzzle pieces together, using the first presented fair value gap, and it's just a combination of time and price. It's not super complicated. I've always overthought this in my own trading, that I would overthink time and price and sort of feel like I was having an interstellar moment of trying to understand it. But really what it is at what time did we open, what time did we close, and at what time did we price in highs and lows. And so that's really all it is, and then just putting it into action. So it's nothing complicated. You can complicate it if you'd like, but it becomes, this is going to sound repetitive, but it's only going to become more complicated. And you want it to be simple, especially if you're trying to build a model. And so that's what we're essentially doing here, even though there is no, this is just, once again, looking at the rule set that I gave at the beginning of the video. So, we have Wednesday, the 1 minute first presented fair value gap, busy, coupled with a volume imbalance. At 9:36 a.m. it's formed. Alright, so let's just, I think it'll be faster if we do it like this. So, here we are, looking at that gap like that. Alright, imagine it's like that. Extend out a couple candles forward, move a couple candles back. Let me take this text off real quick. You see that that is the first interaction with the gap immediately after it's formed. Right, and that wick is kind of a, I'm just going to make this up on the spot here, but a killer wick, meaning it goes down and it goes up. So something is starting here. If we were looking at this sort of real time. Now, once again, the idea is not to position ourselves based off of that wick. The idea is, based off of that gap. The idea is to use that as a measurement and use the rules if and then, basically. So if gap is, or price is above that gap, bullish. If below, bearish. And then we use all the other factors to deem and qualify a setup. Now I'm just going to keep this off for now. No, I'm going to turn it on. I feel like turning it on. So there you go. Next candle we have is 9:39, if I'm correct. Yep, 9:39, 9:40, 9:46, 9:47, 9:48, 9:49. That one is a little hard for me to see, but it looks like the candle is respecting the low. So we just look at the close, 636 and a quarter, and the low is 636. So yes, it's respecting it, and there you go. Now it disrespects it. That is at 9:45, right? 9:45. We have a change in the narrative, right? And we are now treating this as a bearish inversion fair value gap until it gets above. So I'm going to fast forward to all the way, right? So you see how once we close, even though it went up over here, and even though it first traded up into the halfway point and then closed and never really returned, we still have this gap right here. So now that's outside of the model, but that's still there. If you prefer to use just the highs and lows instead of the opens and closes, incorporating the volume imbalance, you'll see that this candle actually, and even this one, deems the change in the narrative, but that's outside of this exercise. Fast forward, 10:43 is what I have logged, so I'm just going to fast forward there. 10:43, we now, at 10:42, we close inside the gap after trading all the way down here. So shorts have been damaged here. We've made a lower high, a higher low, and this gap I have highlighted as the first presented gap after 10:30, and then 10:43 we have this close above the first presented gap from 9:36, right? Okay, so 10:43, the narrative has changed once again, and that gap is to be treated as a bullish reclaimed fair value gap, BISI. I think I said 10:47, I meant 10:43, I'm not too sure. Okay, fast forward. Right here, 10:47, price treats that as a bearish inversion fair value gap. Okay, narrative has changed again, and over here we continue to respect that idea of trading lower. It's trading lower, it trades above it but fails to close until right here, 11:21. And so we have this buy side here that we marked. So that is just an old high basically. And so we'd look at that, okay, now it's closed here. We have buy side very close in proximity. And the market right here should treat this as discount to go up into there. Now my expected, if I'm being honest, just based off the size of this candle, the fact that we opened below it, the fact that we closed above it, the size, the speed at probably which it formed, would lead me to believe that maybe it will just book that buy side first. But let's see. There we go. So not that impressive. Obviously this is hindsight, and so, but you can see that we're warming up our reticular activating system, which is what is spoken about in all these lectures that ICT talks about. So these are how I sort of warm up to these ideas, how I do this for everything. So this is just back testing. Right, fast forward. Where are we in price right now? It is 11:24, so time. And if we're above, we treat it as discount. If we're below, we treat it as premium. Boom, 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 boom. Keep going, keep going, keep going. Boom. Change in the narrative. Okay. We have this little flagpole going on pattern. Not really sure what it is, but what retail would see it as. These candles are fast, they're large, they're rapid. If you're cracked out and a retail trader, that is going to get you enticed or induced, is what a lot of people on Twitter say. So I think the proper word is induction, or people say induction candle. It's just a candle to reel you in, like the sheep, essentially. So we wanted to book that buy side, and it did so, and it's created three gaps actually. 1, 2, 3. Now you could incorporate the low all the way to the high, including that volume imbalance, or you can just do this lower gap because it's lined up with that first presented gap. And then you would take that inversion, because it's a buy side imbalance, you would treat it as inversion because now we have equal lows here, and we've now closed below that gap, so we would act as resistance or premium. And so we're going to see, until the candle closes above, it's acting as a premium, and you can see that we trade below those lows. So these are the key dead giveaways that I have noticed with my experience and time with the first presented 9:30 a.m. fair value gap. Now, I don't know if the 12:30 or 12 true day open one has different signatures, and I'm sure that they have different characteristics, but signatures, I'm sure they're all the same. Alright, so that's it for that one. Now, fast forward to Thursday. This is the last one, and then we're done, right? Okie dokie. So, I'm gonna actually speed through this one as fast as I can. Alright? So, 9:41 is the first touch. First interaction we have there with the 9:31 a.m. Sorry, let me restart. We have this gap over here, first presented gap at 9:31, and then the first interaction is 9:41. Okay, we have the new day opening gap over here. Okay, this is all at 9:30, and I think, if I'm correct, price came all the way from highs. Yeah, so it came much lower during London and traded all the way down into this new day opening gap. So reasonably, obviously, with the benefit of hindsight. Now, to you, this might be jibber jabber, or maybe there's no real basis behind what I'm about to say. But if we went all the way up there to deliver lower, considering Friday is off, there's no trading on Friday last week because of Good Friday. Considering all of that, I don't think that it's just going to go up here and reverse higher and start to, basically there's not going to be a reversal pattern. If anything, the worst case scenario is a pullback into the range and then sweep any lows that have been recently formed. Alright, so 940, bearish fair value gap, SIBI is the function of the market right now relative to that first presented fair value gap at 931. And then right here, once again, not marked, but there it is, 9:52 a.m. We have the inversion bullish fair value gap, where price is now expected to treat that as discount, which is immediately changed right here at 9:57. Okay, and then this gap, I outlined it in my own study, but you can see price goes up, balances this range out, up, down, down, comes back into it, respects the lower quadrant after it's been balanced, and then we trade lower. So if you're bearish, that's a beautiful setup. Comes back into that old sell side pool that's already been met, but you can see old levels cutting through candles. Still, they're being respected. And these are just some old annotations I have. But this is not. I'm gonna remove that, but that was just a delineation of the 10:30 a.m. opening or close. You would be looking at the close. Alright, here's that first presented fair value gap for the what is this? The 10:30 a.m. open. So we've traded to an old low that has been already traded to, and we have a gap right here. Do you think that it's likely that we just trade up into that and then sell off even lower? Well, no, it's Thursday, so we have a bank holiday on Friday, so it's likely to retrace back into the range. We have a new day opening gap here. So now, and as a final point, I said I wasn't going to talk about any other first presented gaps, but this is a good example. Since it's here, it's meant to be. We have this gap, and you do the same exact thing. If close above, bullish. If close below, bearish. Alright, extend it out, close above, there we go. And our draw would be new day opening gap here, which is low hanging fruit. And then I would even go as far as to say the 1 minute first presented fair value gap, SIBI. Okay, so continue. You can see comes down into there. Inversion, like I said, we treat it bullish because it closed above it. And we look for the new day opening gap until it closes below that. Still no close. There we go, close. Alright. So now we treat it as resistance. So notice how the characteristic of the 10:30 is a little bit more different than the 9:30. And that is because there's less volume there. But once again, the idea is still that draw above here. So that doesn't change. So notice how we closed below it, then we closed above it. We closed below it, and if I look closely, oh, well, that kind of gave it away, but that's okay. We closed inside of it, but before that we closed below it. So even this candle, you're still treating bearish until you see this candle right here, which is 11.05. And so going back a little bit, 11.05, things have changed. We treat it bullish. Alright, 11.06, you can see we traded to that new day opening gap, yes, but something I explored in my back testing is, and I don't know where I found this, but it was one of the ICT spaces where he says that in a dealing range, the gaps will typically form in between 40 to 60% of that range. And so it just came to me while I was looking at this, is that we have this high here all the way down to that low, sorry, this low, because this is an expected manipulation leg, is what some people say. For short, it's basically a sell side raid, and you take the 40 to 60% range, and it basically couples up with that new day opening gap. So going short at whether you want to go utilize the new day opening gap or you want to utilize the low, considering it is a Thursday, you have to allow for time to pan out. So you would just look at this. Sorry, considering it is Thursday and we have a bank holiday on Friday, it would take some time before it pans out, but you'll see that it does eventually pan out. We're looking at this high right here, and I'm actually just going to bring that 40 to 60% back. There you go. Alright, so the gap formed inside that 40 to 60%. We draw from the high, and actually I'm missing the volume imbalance on that. There we go. From the high to the low of the classified fair value gap coupled with the volume imbalance. Keep going, keep going. You'll see that it does respect it, and not in a fashionly manner, but it does hold the idea that there was accumulation going on here, and it was inside this beautiful dealing range from the 40 to 60% inside that zone using the new day opening gap. So we have reason to believe that there is volume here. It just takes time to form. And there it is, back to that first presented gap, back to the discount array. So throughout this, yes, it is still treated by the old rule set that we were looking at, the previous rule set. It is still treated as a bearish gap, but because now we're involving more of a in-depth analysis or narrative, advanced narrative, we are now expecting it to form as inversion because we want to see that high booked. And you'll see that it comes down into there, comes back up, and right here we have claimed it or reclaimed it as a sorry, not reclaimed, we have treated it as inversion fair value gap to the upside. So bullish inversion fair value gap, comes down, trades it one more time, and it kind of just like spooks you out of it. But these are exceptions that you as a trader have to allow for if the risk is right, if you know you're drawing liquidity. So yeah, comes up into there and then books the 1001 high. So that is the end of this. If I find some time, considering today is Monday, April 21st, there is always a first presented fair value gap on the weekdays of trading, and if the market is open, it'll give you that opportunity to take part in this exercise. So that was the main focus. Like I said, some main focal points for me were just following a process-orientated thinking and the importance of candle closes. So through this, usually what I do is I go through these and I just write down questions. So I have a paper for writing down all the logs that I read out, and is basically the script of this video, but it's actually just notes. So what I would write real time in the market if I were at my desk and had a pen and paper, not on mobile. So that is basically my script, because it's my notes, it's what is familiar to me, and it's not really like too much text. It's just levels, times, PD arrays, annotations, abbreviations, all that. And then on the side, when I'm back testing, I have a separate pad that I use for questions. So I write down all my questions that come up in my testing. And one thing I'll share with you is a weakness of mine, actually, is when the draw is lower, how do you identify the top? That's something that I notice in my real-time analysis, and it's mostly on the go. But when I notice, actually, that's not true. When I'm sitting down on my desk, I tend to overthink when the topping formation will come. Even though I have a beautiful draw that I am most certain it's going to hit that level, I need to identify the topping formation. So this is a weakness of mine that I write down, and an adversity becomes an objective. How do I make that a strength? So lots of signatures that occur in price, and it's just a matter of training your eye to catch those signatures. So in this one, how I answer that question was just one answer for that question was, instead of catching the top, right, just wait for the close of the candles, right? That gives you a lot more clarity. And then waiting for the close of the candles and not going short immediately, but then waiting for an additional setup to present itself. And this is where you'd refer back to core content month 1 for best entry setups, meaning you don't want to be buying when the candle is down closed real time. You want to be buying when it's going up, and that's where you'll find your best setups relative to a premium and discount. So if you're looking for the best top, we want to wait for it to get below that gap, that first presented gap. We want to wait for it to trade below it, close below it, and then we want to identify the dealing range, and then we want to identify the equilibrium and look at the premium, and then we want price to trade up into it, and that is the highest point or form of short selling. That's where you'll find the highest probability. And as it trades lower, you want to be taking partials, you want to be closing out your position when it trades to discount or the dealing range low, but you don't want to be taking shorts in the lower quadrant of the dealing range. That's low probability and it won't form. And you can see, obviously this is Thursday, so we close, but if we just look at this little segment of price over here, say we're using this to go short, dealing range is here. You can see, well, this is a terrible example because we have Thursday's close, and then it reaches into the close. But you can see how it just really edges you because of that gap. So don't focus on that too much. Focus more on everything else throughout this video, and you'll have yourself a very easy and simple model to follow. And it's something that I obviously it's spoken about in lecture. Everyone knows about the first presented fair value gap, but it's my one of my weaknesses was determining a bias in the first 30 minutes or first hour of trading, and this really helps. If you have a draw identified since, let's say, 8:30, 7:30, and you're following these exercises, it's so fun. It's so enjoyable to see these things happen real time. When you have rules that are hammered into your head, it becomes an exercise. It's like the first time you exercise, it's stressful, it's hard, but then when you start to do it for months and years, obviously there will be points where you'll become fatigued or you won't feel like doing it that day, but it becomes habit, it becomes routine, and it becomes easy almost. It's like if you don't do it, you feel off those days. So my throat is exhausted. I'm gonna end this video. I hope you found something insightful. Really, I hope you did, and maybe you can incorporate this into your own back testing. Maybe if you found it a little confusing, let me know, because then I prefer these videos. I don't think anyone is really going to watch an hour, but if you just watch the first 2-3 days of the back testing that I did from Monday, Tuesday, Wednesday, you have an idea, and it's really not that hard. It's a very simple idea. So yeah.